Investing in the stock market can seem like a daunting prospect for a generation of young adults who have just a few cents in their pockets and $100,000 in student loans for a degree they don't even use. However, when done right, you can take those few cents, turn them into more, and grow your wealth. After all, isn't that the goal? In all seriousness, the stock market is often perceived as either a big, scary abyss that eats unsuspecting investors alive or a path to immense wealth for those who understand it. While these perceptions can hold some truth, understanding the stock market and making money with it is far easier than you might expect. Understanding stocks. To understand the stock market, we first need to grasp what a stock is. A stock, also known as a share, is a financial instrument that signifies ownership of a company in some proportion. For example, if Amazon had 1,000 shares and you bought one, you would own 1,000th of Amazon. In reality, companies like Amazon have millions of shares, but the concept remains the same. When you own a stock, you own a portion of that company. As the value of the company increases, so does the price of your stock. Stocks can be categorized as common or preferred, which determine shareholder rights. Common shares come with voting rights, allowing shareholders to vote on issues such as board elections and mergers. Preferred shares, on the other hand, typically do not carry voting rights but get preference when a company pays dividends, a share of the profits, or during financial distributions. Stocks can get more complex, but these basics are enough for a beginner investor. Why companies sell stocks? You might wonder why companies sell stocks in the first place. The answer is simple: to raise money. Stocks allow a company to generate massive amounts of operating capital without producing additional goods or services. The modern stock market often values companies based on their potential future earnings, meaning small companies can sometimes raise millions or even billions if investors believe in their future success. Companies sell shares through an initial public offering, IPO, which transitions a business from being privately held to publicly traded. IPOs can help founders cash out their stakes or simply raise funds for growth. Once listed on an exchange, the public can trade these stocks. Prices fluctuate based on public perception, company earnings, and operations, measured using metrics like price-to-earnings, P/E, ratios, and others. How share prices fluctuate. The stock market consists of millions of investors and traders who make independent decisions about buying and selling shares. These collective decisions drive stock prices up or down. If more people want to buy a stock than sell it, the price rises. Conversely, if more people want to sell, the price falls due to a lack of demand. A simple analogy: imagine you post an item on Craigslist for $100. If 100 people contact you, willing to buy it immediately, you might start thinking you underpriced it and raise the price. On the other hand, if no one shows interest, you might lower the price until someone buys it. This is similar to how stock prices fluctuate, except that these changes occur at breakneck speeds through millions of transactions every second. At the core of these movements is supply and demand. For every stock trade, there must be a buyer and a seller. If demand exceeds supply, prices go up. If supply exceeds demand, prices drop. Why invest in the stock market? You might be thinking, why should I invest in the stock market when I can earn 2 to 3% annually by keeping my money in a high-yield savings account? The answer is simple: with the right investments, you can earn far more. Consider this example: if you had invested $1,000 in Amazon stock in 1997, it would be worth around $1.5 million today. While this is an extreme example requiring a long-term timeline, many companies offer annual returns of 30 to 70%, significantly outpacing the 2 to 3% you might earn from a savings account. As long as you can earn more than 3% annually in the stock market, your money is working harder than it would in the bank. Getting started. To start investing, you'll need a trading account. Popular options include services like E-Trade or major banking institutions. Free trading platforms like Robinhood have also made investing accessible by eliminating trading fees, allowing you to invest your full amount without worrying about brokerage costs. Once you have an account, the next step is deciding which stocks to purchase. Stocks can range from a few cents to thousands of dollars, so you'll need to research companies to understand how they make money, their financial stability, and expert opinions on whether they're worth investing in. It's crucial to invest only money you're comfortable losing, at least temporarily, since stock prices can fluctuate significantly. Conclusion. In this guide, we've covered the basics of the stock market, how it works, why companies sell stocks, and how to get started. While we haven't delved deeply into technical analysis or advanced trading strategies, these fundamentals are enough to help a beginner take their first steps. The best way to learn is by doing. Take a small amount of money you're okay with losing, start investing, and gain experience.